Good afternoon, Ken McCoy with Petaluma Home Loans.
And Debbie Benson-Miller with Prime Real Estate Services.
And welcome to your Tuesday tip.
Today, we have some questions for you, Ken.
Okay.
This is a little difficult to explain, but what is APR versus interest rate?
That's a very commonly asked question. APR, first of all, stands for annual percentage rate.
Okay.
And an APR is the government's attempt to show a borrower what their closing costs cost in the form of an interest rate so that borrowers can compare loans. The problem with using that is that one of the items in calculating the APR is a variable item, which means that depending on the day of the month that you close your loan, that number is going to be different. So it's never really fair to use APRs to compare loans.
Sure.
You always want to look at what the note rate is, or the interest rate, and the actual closing costs. And that's a very good way to be able to compare those interest rates or compare two loans.
Sure. Okay, so somebody actually could come to you and say, I'm getting a better rate here, and they aren't because they're looking at the APR.
Because they're looking at an APR, that's correct.
Okay,
yes.
Good to know.
Yeah.
Really good to know. So, because we're talking about APR and interest rates,
right.
So how important is your credit score in getting a loan?
Okay. And again, another very important question. When a borrower comes to us, lenders take a look at all three credit bureaus. So you have TransUnion, Equifax, and Experian.
Okay.
We're going to take the middle score of those three, so not an average, but whatever the middle one of the three is. And we're going to take that for all of the borrowers that are involved in the transaction.
Okay.
And then we're going to take the lowest of all of those middle scores, and that's what the entire loan is going to be based on.
Oh, wow.
So if you have one weak link, that weak link is going to be what the entire loan is based upon.
Oh, wow.
So that's one thing that your credit score affects in a loan. If you have mortgage insurance on your loan, it can also affect the rate on your mortgage insurance. It can also affect whether or not you actually get your loan approved.
Oh,
and
that's big.
That is big. And the reason being is lenders take a look at a whole bunch of different factors, and credit score is one of those factors. And if you're weak in the other ones, credit scores can sometimes lift you above those other factors to give you an approval. But if you don't have a strong credit score, it could actually bring you down, which means you don't get an approval on the loan.
So, knowing how important it is, after hearing this, is it possible to change our credit score?
It is. You know, one of the things that we do as a local lender is we work with the borrower. If they've got a credit score that needs improving, we work with them to get that improved. It doesn't change anything for us as a lender. We get paid the same whether your interest rate is at 3% or 30%. But it does make a difference for the borrower. And so yes, we will work with the borrower, and there's lots of simple things that we can do in a short time period in order to improve that credit score, if that will make a difference on your loan.
So again, you should probably do it ahead of time.
Yes.
So you kind of know where you're at. So don't hold off. Go see you early.
Early, that's correct.
Okay. Well, thanks so much for telling us about that, Ken.
Yep, thank you. We will see you next Tuesday for a Tuesday tip.
See you then.
Bye-bye.